In day trading, before you put in a trade, the first question is, what is the trend direction? Should I go long or go short? Because if you are wrong with the trend direction, you could lose a lot. But on the other hand, if you get the trend direction right, even if you don't manage your trade well, you don't end up losing much, or even you could have a small profit. So that's why it is very important to decide the trend direction. There are a lot of ways for you to decide the trend direction, but normally there are 4 of them. You can read the signs one by one and then combine them together to decide the trend direction. First, you can use highs and lows. This is the basic definition of a trend. If you see high, higher high, low, higher lows, that means it's an uptrend, and vice versa. Second, you can use the candlesticks, because each bar will tell you a direction, no matter what. So you want to classify the candlesticks into trend bars and non-trend bars. So based on the characteristic of the candlestick, you can also tell the trending or the strength of the market. You can also use the support and resistance levels or value zones to decide whether the next move will be up and down. This is because the market is just a human psychology. So when we go to a support, we tend to pause and then bounce back. The same thing for the resistance. Last is the trend line. So basically, it's the similar concept to the support and resistance. Then we assume the market will bounce back between trend lines. So when it breaks, there will be bigger opportunities. Now let me use this chart on the screen to show you an example. How to read the signs to determine the trend direction. Because when you read it correct, you're gonna get profit. Otherwise, you could lose. First, let's take a look at the high and lows. We have 2 highs here, and this one is a lower high. And then what about the lows? We have 2 lows. This low is lower. However, this is not a good way to read the downtrend because these 2 lows are consecutive. For high lows to define the downtrend, it should be high, low, lower high, and another lower low, rather than 2 consecutive lows. So this is not a good way to define a downtrend. Next, let's read the candlesticks. So at a glance, you can see that we see bigger bars as a bear bar, here and here consecutive. But for the bull bars, they're not very strong. So the downside pressure is much larger than the upper side pressure. Now let's have a look at the trend lines. Because we have 2 highs here, we can connect them to have a trend line, which is a downward. And also let's take a look at the levels, whether we have any. We can say that these 2 lows, they can define a level, horizontal, because they are very close to each other. Then in this case, we can see the whole market right now is in a wedge, and then it's shrinking. We're expecting the market to break either upside or downside. Next, we can see the market is breaking the support level to the downside. And then for the wedge breakout, we want to wait for the pullback and then trade accordingly. So now it seems that the market is going down. The next bar is a bull bar. This is the pullback. You could, if you think this is a downtrend, you could trade to the downward and then go short after this bar finishes. And then next is another bear bar. So this could be a confirm of your downtrend. However, later on, you can see that the market didn't go down. Instead, it goes up. But what's wrong here? Why it seems that to be a downtrend, but it turns out to be upward? First, take a look at this huge bear bar. The body is very small comparing to the whole candlestick, a big tail at the bottom. The big tail at the bottom means the support, which is the upside pressure rather than the downside. That's the first sign. The second sign is this bull bar. This is a bull bar rather than a bear bar. If it is a bear bar, even if it doesn't go much, 2 consecutive bear bars to break the support level, it's still downward pressure. But at this moment, it's hard to tell. So you need to hold your position rather than enter into a short trade. The third sign is these 4 bars. It seems that the market is not going anywhere. It's consolidating. It's still along this support line. So that means this support line still works. So if that's the case, it's not a good sign to tell you whether it is still in a downtrend or it's an uptrend. So in this case, you want to hold your position rather than trade. Another mistake beginner traders make is that when they're seeing this huge bar in the middle before finish, because the market is still going down, and at some point this bar is very huge, it's a bear bar, so they rush into the market to take the profit. However, the market goes back, so they end up losing more. So one thing to learn is that never put in your trade before the bar finishes, because your investigation, your research, your homework is based on the finished bar rather than the bar is still in the progress. Then after that, the market looks like this. So what do you want to do? Let's do the same analysis again. We have 2 highs. It seems that they are horizontal. We have 2 lows, similar that 2 lows are consecutive. This doesn't define a trend. And then we have a horizontal level here, which can serve as the resistance, because the market goes up here to test the previous high, and then it bounces back. And then at the bottom, we can also draw a trend line here. We can draw the trend line connecting these 2 lows. However, normally we want to draw the trend line ignoring the big tails. Then you can argue, okay, we're reaching the resistance. It's bounced back. Let's go short. So this is an open triangle. So we are targeting the profit to be the bottom trend line here. However, if you enter the market when you see these 2 consecutive bear bars, right after that, the market goes back. So you could end up losing again. Then how to correctly rate the chart and then do the trading? Let me show you. First, again, we have the 2 highs here. We first connect them as a trend line. So one basic thing is that whenever you see a trend line at either top or bottom, you want to do a parallel to the other side. Apparently that these 2 lows here follows this bottom trend line. That's good. So it seems to be a downtrend. Then we are waiting for the market to break or to follow the trend lines. Then we have the market breaking down. However, this big tail, like I mentioned previously, big tail, you shouldn't be targeting it as a break, because the big tail means the support in this case. So the body is still within the channel here. So it's still following the trend line. So we cannot say it's a break to the downside. Then the next few bars, you can see they're still within the downside range here. It's not piercing. Like I mentioned, if there's another bear bar piercing this bottom trend line and then goes down, that means it's a break of the downtrend of the channel. However, given these 4 bars here, the body are still within the range. It is still following the range. So that means when you see this bull bar or even this bull bar, you can trade upward because it's following the down channel here. One thing to mention here, because the channel is going down, so the probability for trade to go up is generally lower than the probability of the trade going down. So in this case, you want to decide whether you want to go long or not. Then next, you can see the market is breaking the top trend line. So this is a channel breakout. So higher probability the market will pull back and then go up. So the probability of going up is higher, and then the trading opportunity is to go long whenever you see a pullback. You need to wait for the pullback to finish before you enter the trade, because you need to confirm whether the market wants to go up or not. When you see these 3 consecutive bear bars, even they are consecutive, however, they are not very strong comparing to these 3 uptrend bull bars. And then these 3 uptrend bull bars will give you the direction, because these 3 bars reversed almost all the previous bars, and then it goes up. This is one sign. The second sign is that the market goes down to the pullback to test the top trend line, and then it reverses. That means it fails. It treats this top trend line as the support rather than resistance. The third sign is this bar. This bar is very huge bull bar. It is larger than any of the bars on the left, even larger than this bar. So this is a very good trend bar. You're convinced that it is an uptrend. So you want to go long after you see this bull bar and then enter the market as a long. This is how it looks like in the end. You can see that your entry is here. There are 4 consecutive bull bars after it, and then the trend is very strong. So if you enter here, still you can make a lot of profit. To sum up, basically you want to rate the high and lows, candlesticks, support and resistance, and the trend lines, and combine them together to help you to determine the trend direction, and then enter the market at a good timing.